Good afternoon, everyone. Thank you so much. As you heard, we are just about to do this panel. Please, grab a seat. We wanted to talk about financial inclusion, in part because of the role it plays in reducing poverty and also boosting shared prosperity. I mean, I suspect I don't need to tell anyone in this audience, but the fact is the World Bank has identified it as an enabler of 7 of the 17 Sustainable Development Goals. So it is crucially important, and yet we're here at a time when many people still remain unbanked, and there is also a trust issue, despite the fact that we're coming out of the COVID pandemic, and that actually has helped accelerate in some ways the sort of pace of technology development that we've seen. So the idea is, during this discussion, we're going to discuss whether a trusted financial ecosystem that includes everyone, whether that is actually possible, the role of technology in that, and together we will also explore what needs to be done across the public and private sector to make this progress achievable. And so with that, let me please introduce to you our distinguished panelists today. We've got Suman Berry. He is an economist, an academic who is vice chair of Niti Aayog, and also after many years at the World Bank, so very familiar territory, Washington, for you. He was also Shell's global chief economist. We also have Odile Renaud-Bassot, who is the president of the European Bank for Reconstruction and Development. So thank you both for joining us. And you may have noticed we were meant to be joined by a third speaker, Fabrizio Kakaribu, but unfortunately, he's been caught up, I think, in a meeting across town, so he will not be joining us. So we can dive straight in. You know, I mentioned there that we have seen many people still unbanked despite the progress. I believe the number is about 1.4 billion adults remain unbanked. Suman, if I could start with you, what progress has been made and sort of where do we need to go next?
Well, I am now heading this agency, Niti Aayog, which is the government's indicative planning arm. But I've been a development economist for many years, more years than I'd like to admit, starting as a young professional at the World Bank. And I think the first point I'd like to make, I don't think this represents, blinkers, is that in my early years as a development economist, we focused on what economists call the real economy, savings, investment, infrastructure. And there was a sense that finance would kind of take care of itself. So I would say that the notion that financial inclusion is central to the development process is maybe 20 years old. The second point I'd make is that this is not just a developing country issue, that payday lenders and unbanked households are as much an issue, not as much, but are an issue even in the rich world. So we're talking about something which is of significance even in the more in the richer world. The third point I'd make, but I'll come to this later, is that India's experience indicates really how quickly things can change. In a period of 8 years, we've gone from 35% to 80% of adults having bank accounts. So the session is this financial inclusion's moment? And I hope that I, on the basis of the India experience, could indicate what has changed and why that's important for development and potentially even for more advanced economies.
So I'm hearing you say it's no longer an afterthought.
No.
But Adil, if I can bring you in here then, what are the challenges that sort of prevent it from moving faster, perhaps, than we're currently seeing?
I would like to start from a sort of broader perspective, which is, it's important. I mean, and what we mean by financial inclusion, because financial inclusion, it's having access to bank account and so forth, but it's also having the capacity to get access to financing. And from our perspective, EBRD, which is a sort of bank MDB financing development and our focus is historically post-communist countries. So we were created when Berlin Wall fall, and in order to develop market economies, private sector, and so forth. And so our scope is not so much, I mean, and our lens is not so much, I mean, individual bank accounts for household and so forth, but also access to finance in order to develop business activity and so forth. And on that, I think we've made progress. I think this is part now of, I mean, there is a clear understanding that this is needed in order to have sustainable growth, because you need to, I mean, otherwise you have pockets of population who cannot, I mean, enter economic activity, but there are the obstacles maybe, I mean, are partly or partly it's difficult to, but societal, you know, vision of the role of women, the role of young people in society, their capacity to develop business activity and so forth. So it's not only technical, financial, technologic, but also a bit of, you know, the vision of how the society should function.
So when you're thinking about this idea, then it's not just about individuals having the right to access that formal sense of the banking system, but it's also small and medium enterprises and that kind of idea of payments.
Yes, absolutely, because it's the capacity to have access to credit, for example, because you can have a bank account but have limitation to have access to credit. If you want to develop your business, buy some raw materials, you cannot do it, and so forth. So, and that's why also it's very relevant. The question is not only relevant with the least developed countries, but also middle-income countries, emerging countries where you can have access to bank account, but a young woman would not be in a position to be able to develop its business, and it can be a very small business because there is no access to credit.
But yes, sorry.
No, I just, if I could, build upon what has been said. I think Odile is absolutely right that, firstly, as I said, we focused on the real economy. Then, including in my own country, the issue became one of providing credit. And there were all kinds of specialized credit lines that were created, often subsidized. And in our country, in my country, we went so far as to nationalize the banks because there was a feeling that the banks, when owned by private individuals, were too conservative and did not have the capacity to assess risk in rural economies and what have you. So that was, as it were, stage one. How do we get credit? I think what we've discovered now is that there are many other benefits. Firstly, we have this concept of the informal economy. And what we have discovered in India, and this was an insight that also came from Hernando de Soto of Peru, which is that what gets in the way of being able to provide credit is identity. And so informality is often associated with uncertainty about identity. And therefore, the Indian system has been very much built on digital identity. So that's been the game changer for us. But then you also have the fact that if you can reduce transactions costs, because banks, conventional banks tend to charge, I mean, that's how they make their money. So that then encourages transactions. It encourages people to establish, therefore, a credit record based on their payments. And this was something that the big Chinese platforms also discovered.
There's a lot to unpack there. You brought in the role of the private sector, the idea of trust when it comes to identity, and especially when you're talking about an informal sector. But I want to go back, probably at this point it might be helpful, to explain what did happen in India and how that is an example of sort of where financial inclusion has been working.
As I say, the original innovation was to realize that modern information technology could establish, it was a choice that identity could be a digital identity, okay? And so we now have gone from, 2008 to now, to a situation where 1.3 billion Indians have a digital identity.
But so how did policymakers lay the groundwork to help that develop?
Well, by agreeing within government. Well, lots of countries have had national identity cards, okay? But I think what was idiosyncratic in India was that a lot of the attributes like first name, last name, these are much more confused in an emerging economy than they would be in an advanced economy. And so the basis for unique identity ended up, particularly when people are illiterate, ended up being physical characteristics like fingerprints or retina scans. And the key, and I'm not a technologist, but the key technological breakthrough was to run databases of enormous scale to avoid, to what they call deduplicate, to make sure that when somebody presented their credentials, that this was actually the person who was associated with a particular digital identity. That then got around a huge number of barriers that were involved in setting up a bank account, because banking system all around the world have to have a so-called know your customer rule. And so the digital identity allowed the banks to accept that person X was indeed person X.
And that's how it allowed you to scale up.
That's right.
And sort of do it in such a big country.
That's right.
But maybe an important element, because we were specific, the specific challenges to identity, multiple identity, and so forth. But very often what is extremely important is to have the regulatory framework, the legal framework in the country, in order first to acknowledge that digital identity will have value, digital signature can have also value, that you can do know your customer procedure through a digitalized process and so forth. So all this, to be able to be implemented, you need to have the right regulatory framework and the acknowledgement by the authorities that this is legitimate and can function. So that's a very important step, very often, to have this sort of legal architecture.
I mean, I think we keep dancing around it, but we're talking a lot here about trust and this idea of people having trust in a system, whether it's individuals, whether it's the counterparties involved. How do you get to that? Is it simply a question of regulation, or are there more steps involved to build trust? What does that look like?
I mean, the regulation is, I think, the basis for trust, because you need to be sure that this is legitimate and to have the guarantees in the process, for example, for the digital identity, that, okay, this is a paper which is confirmed and you can, so that's the basic for the trust. I think then you have another layer of trust which is more related to the technologies, the risk of hacking, cybersecurity, and so forth, which is also very important for the system to function with a trust.
Data protection, which we're talking about here in the United States with big tech companies, that issue of once you bring in technology, what do you do to protect it, that information?
Exactly. Data protection, privacy, and so forth, and also the fact that the system cannot be forced and cannot be misused, and so that's a very important element of trust. And then, in a way, what happened recently with SVB raised another issue, which is the impact, but it's a bit, we are moving a bit away from financial inclusion, which is technology and the digitalization, how it can also contribute to destabilize trust, because movement can be much quicker and so forth. So this is a sort of new developments we just saw a few weeks ago.
Yeah, I mean, we've seen this acceleration, the speed at which things can go south is much faster than perhaps historically. I mean, I wanted to ask you about this idea of trust, because right now, if you look, survey after survey shows people have low trust right now in government, they have low trust in the financial system, as demonstrated by the 2 bank failures you mentioned. I mean, how do you see it, Suman?
Well, I think we've learned since the Great Depression and now that trust in banks and the banking system is one of the most important public goods in any society, and the vast regulatory apparatus of supervisors, etc., exists to make people comfortable in keeping their money in banks. It wasn't always so. Okay, so I do believe that while there are a lot of add-ons, trust in the banking system is fundamental, because banks create money, and there are very, sizable and complicated rules about liquidity management, this, that, and the other. And I would say what we've seen recently here is basically, in that sense, a sign that in an era of rising interest rates, people started to get nervous. But I want to differentiate that from, as it were, the issues of technology and financial inclusion, which at least in India ride on top of banks rather than so far substituting for banks. And there I think the trust issues, which are, are pretty important in a poor country, is do you trust the intermediate technology? One of our great achievements in India is something called the Universal Payments Interface, which allows a mobile phone essentially to execute transactions, but always based on an underlying bank account. But you don't have to remember the details of the bank account number. You just need to know the correspondence mobile number, and most people know other people's mobile numbers.
So, I mean, we're talking there about what can be done to help ensure there is trust, and that trust and this digitization can coexist. We haven't got anyone here from the private sector, so I'll sort of play that role, which is, how do you gain the private sector's trust? I mean, obviously they are there to make a profit, so how do you persuade them that this is kind of a worthwhile enterprise for them to be engaged in, that there's something for them in it, to trust policymakers to work with them side by side?
Just quickly on that, we're speaking in the US, and so, but not everybody watching would be from the US. But when I got here literally 50 years ago for graduate school, zip codes were still relatively new. But government started gathering data based on zip codes, and now there's a giant data industry which uses public databases on zip codes for mortgages, this, that, and the other. So that is the model of public and private that I think India has followed, which is that, we will provide the basic identity architecture. We will provide the basic interfaces for electronic transactions. But then you can build all kinds, because it's an open architecture, it's not a closed architecture, you can build all kinds of value-added apps, if you like, on top of that. And that has stimulated huge startup activity in India.
Maybe from a different perspective on your question on why the private sector should have trust in the public authorities and so forth. We are talking about the financial sector, and to be trusted, financial sector needs to be regulated in a way, and I think that's why. In this sector, in particular, I think that having regulation mechanism that ensure, that the identities are checked, that your counterpart is the right one, that the bank or the place where you put your money is regulated and have sufficient liquidity in order for you to get out your money whenever you want and so forth. So this is key for the trust of the customers, and that's where such players need, in this business, you need to have some regulation, and that's part of the key element to build trust. It's, your person, the companies, the private sector own capabilities, but also having, this sort of public sector of regulation blessing is one important element of the trust, I think.
Could I just say that because this is India's year as G20 president, that there is such a thing as the global partnership for financial inclusion. And, so India is using that platform to make some of its technological achievements accessible to other G20 members and to publicize them. And indeed, it's partly for that reason that I was very pleased to accept this invitation, because, we've developed a structure that used to be called the India Stack. And we're beginning now to include neighboring countries so that, for example, India is the largest recipient of cross-border remittances in the world, $100 billion.
Which held up remittances. That was one of the things during the pandemic because of technology.
Yes.
It held up in a way that people previously didn't think.
But at a cost to the person sending the remittance. So reducing, as it were, intermediation costs for cross-border has been an agenda item of the G20 for a while.
We're running out of time, but I really quickly want to ask you, we're hearing some countries, they're toying with the idea of introducing a central bank digital currency. Do you think that is a good tool to help expand financial inclusion?
I think it can be a good tool. It needs to be, central banks are very trusted entities. So I think that would be, and they would have the appropriate level of transparency and regulation in order to ensure that this is, so that could be, I think, a good tool. We see now, on what happened with cryptocurrency, that, the other side of the story with, development of, unregulated and some challenges in relation to, to the consequences of such development. So I think that's, but there is one aspect of financial inclusion which we have not, a bit less technological, but which is very much related to the regulatory environment and the social, as I was saying at the beginning, a bit the social environment about how do you ensure that all categories of population can have access to financial services, can have access to credit and so forth. And it's also very much, a lot of work has to be done on access to collateral, avoiding, gender-biased analysis. So it's not only technology that will allow, that will facilitate financial inclusion. It's a key element of it, but you have also a number of other elements that needs to be taken into account.
So potentially the dark side of technology is that idea that biases can be replicated or worsened in the digitization of financial.
Yes, and there is a lot of work that also, to complement technology and to accompany technology that needs to be done in order, for example, to, sort of qualitative human dimension component to help banking.
The human face of banking doesn't disappear.
No, you have people judging whether they want or not to lend and so forth. So maybe at one point we have artificial intelligence selecting the debtor and so forth, and then you can maybe completely avoid the gender bias, for example, but it's still early time for that, I guess.
We are almost out of time, so I'm sorry to interrupt you there. But one last thought, 30 seconds, not much time. What does success look like to you? If I could start with you, Suma.
Well, in a in a emerging market, a large emerging market like India, it is that you have a financial system, certainly that's trusted in terms of payments, but we must return to the credit function, because what it has been the case in traditional banking is that it has been collateral-based banking. Digital banking or financial inclusion allows what they call an exhaust trail of transactions to substitute for collateral. So the democratization of credit as a consequence of digitization is, I think, the great promise.
No, for me, the success is that, we managed to have more people having bank account and having access to credit, being the young people, women, in order for, sort of on an equal footing, having access to credit in order to be able to develop, to grow their own business and to develop, to have access to economic growth. So
to address gender barriers, and both of you have talked a lot about credit. And the other thing that came up again, regulation is one of the rules of the way to kind of ensure there is trust in the system. Thank you both very much. Odile Renaud-Bassot, President of the EBRD, and Suman Berry, economist and academic, Vice Chair of Niti Aayog. Thank you so much for your time, both of you today. Thank you.